welcome to the MEIR dialogue on the Middle East conflict. I'm Osama from Middle East Insurance Review. Our platform, Middle East Conflict, the MEIR dialogue, aims to cover key impact of the war on the insurance industry across MENA as well as its overall impact globally. Actually, in addition to the meetings conducted on this platform, meetings conducted with CEOs and experts, MEIR also offers daily newsletter on the situation on the whole. Today joins us Mr. Yassir Albaharna, CEO of Trust Reinsurance Group, to provide an overview of the market and the impact of the conflict on the overall look. Yassir needs no introduction. He is one of the prominent figures in the Middle East insurance and reinsurance industry with around 4 decades of experience. Thank you for joining us, Yassir.
Thank you very much, Osama, for the interview and for your kind words.
Actually, at the beginning, in addition to looking at the overall view, it would be good also and useful to throw some light on the concept of the war insurance itself. Can you describe the likely impact of the Gulf War on the various insurance classes?
Classically, a war of this nature affects all classes of business, some more prominently than others. So classically, it's the marine, aviation, credit, contingent, business interruption, and political risks. These are the primary targets where you will see the effects of war in any country. I have to say so far, and today we are on the 17th of March, the impact has not been on physical losses per se. It has been more on the disruptive or the disruption kind. Disruption in the supply chains, disruptions in the logistics, and what have you. The immediate effect, as always in any war, is the marine, because marine is the natural entry point for many of the classes of business. And what you have here is a situation which we have seen in other wars and similar conflicts of the past, is that in Lloyd's, the Joint War Committee makes a decision to activate the standard mechanism, which is a notice of 7 days. And after the 7 days, there is a reinstatement of the war covers as far as war hull and cargo. And what they do is they define what they call our listed areas. And as we speak right now, the listed area is defined under a certain parameter. That is to say, the nautical miles, I think it's about 23 or so nautical miles off the coast of Iran, and all the Gulf territories. So once you have listed areas as defined, every review, normally it takes on a daily basis. So the rates gets revised. That is to say, the war cargo and the war hull rates gets revised. And the insurance carriers itself have to make the decision to bind the cover and to continue or not. Something very similar to this and mechanism also happens on the aviation side, because in aviation, as you know, there is the standard aviation write-up provision, what they call AVN 42. So there are also defined areas or spaces in which aircrafts would have either exclusion of cover or negotiated rates for the coverages. But today, aviation war is not largely affected because most of the Gulf-based airlines have either reduced substantially their operations or transited through other routes and other hubs, and operate a limited service. So these are the main, let us say, constituents. And of course, what you hear in the press, rates have increased, and there is a large outcry on this particular effects. One area of risk, which I believe some people do not get noticed, but we do see it, and we do see it where I sit right now, is the increased cyber risks. There are increased cyber risks today, and logic would say even after the war finishes, there will be this increased and heightened threat, be it through denial of access or phishing emails and so forth. So this is one area of the insurance, which I said, the aviation, the war, which will have its ramifications on the other classes. And of course, this is part of the macro economic role, where we will have stock market volatility, we have supply chain restrictions, and also inflationary pressures, which unfortunately has crept in the equation.
So my next question is, what's the insurance difference between war and political violence?
Marine is the mother of all classes of business, and the Marine Insurance Act 1906 has been the milestones in defining many of these terms and conditions, which have crept even in the aviation market or in the non-marine market. Their war and warlike risks like piracy, insurrection, mutiny, and the likes, civil commotions, riots. This has conjured up a whole addition to the standard So you have ordinary risks and additional risks. So the market has developed, and of course the marine market has been at the forefront. And this is why war is covered as either a natural rider or an extension through the mechanism that I have described. And something similar to this happens in the war. Long time ago, or some time ago, sorry, there has been a bit of difference into what constitutes riots and civil commotions in any particular country. So markets have developed, instead of the standard SRCC, strikes, riots, civil commotions clause, to try to bring in, let's say, a new flexibility into this political violence cover. As you know, war, even war is not overly included. War between the five superpowers is naturally excluded. So almost all insurance contracts have a war exclusion clause. And the only way to include war is to have a rider, an addition. Okay, this you can purchase upfront. You are not wise enough to purchase it later on down the road. So the political violence market today does cover war. And the impact would be both today, as we assess the Gulf War, both on the war, which is largely affecting the marine, the aviation, and the war exposures coming through the political violence. The latter will obviously be more a disruption, that is to say, disruption of supplies from A supplier to B manufacturer triggered by the war.
How largely is war risk insured against in the GCC?
Traditionally, as I said, war has been a specialty of the London and particularly the Lloyd's market. And Lloyd's today covers a lot of the war risks insurance, be it both for marine as well as in aviation. And there are also specialized underwriters outside of the London market who underwrite Lloyd's as a reinsurance business. Of course, what we have here closer to heart in Bahrain, we have the so-called AWRIS, the Arab War Risks Insurance Syndicate, which is about 194 member insurance companies from the Arab world who have this syndicate facility, which provide this war cover. They have a similar trigger mechanism to what I have described earlier on with Lloyd's. And as we speak every day, our company is also a member. We do receive on a daily basis the reinstatement of cover with revised rates, if any, on a daily basis. You see, the whole idea of this is not really disruption for insurance companies. Insurance companies want to provide cover, but obviously having the war taken place, there is a need to reassess exposures, accumulations on a daily basis. And this is why the freedom is there to amend rates, amend what I call our listed areas or geographical areas, which extend from Hormuz up to Suez Canal. Having said so, I do not regard outside the marine. I mean, the marine is largely insured with war, I would say. War and warlike. Aviation, all major airlines would be buying the aviation extension or rider, AVN 42 right back, as we call it. Outside from this, as you pointed out, Osama, in the Middle East and in the Arab worlds, the penetration of insurance is not high. It is low compared to other developing countries. So not many commercial entities, let alone personal lines, do purchase war and warlike. So, for example, automobile, buildings, etc., I would say they are not insured, and very few would purchase the additional insurance to cover all of this. I also would like to note something which has been regularly featured in the press lately, which is the U.S. facility by the DFC which is reportedly led by Chubb for a 20 billion rolling basis cover. However, the details are sketchy. We don't know what kind of vessels will this be insured with. We don't know what are the qualifications required, etc. So maybe this will ease up the burden and provide an additional facility or a cover as we speak.
So, if I'm presently uninsured for work risks, is it too late to obtain coverage through an overrider, and what is the cost? Will it be expensive at this stage?
Well, there is a saying in our industry, once your house is on fire, it's too late to buy insurance. I would say it would be difficult to go from completely uninsured today, that is uninsured for everything, and to request insurance for everything, including war. I believe the priority of insurance companies, and in Bahrain, for example, we are seeing increased demand for riders, for people or entities, personal lines, who already have insurance and they want the additional cover. However, it is not cheap. It is expensive. It is relatively expensive as we know there is a war going on. This is a natural, I would say, reaction. So I do not say it is impossible, but please bear in mind that overall insurance companies in the Middle East do not retain much risk, and they are obviously reliant on the reinsurance capacity that they have, and also reliant on what kind of rates the international community will allow to cover the additional extension. Yes, you can purchase, but probably the limit will be smaller than you expected because you will try to downsize it depending on the price involved.
As a reinsurer, I would like to ask you, how do reinsurers assess geopolitical risks? Can war risks be modeled like other natural catastrophes and the like?
On reinsurance, I would say yes. Of course, it's not a perfect science. Reinsurers have the knowledge, the ability, and the data, obviously, to model many, many risks. And I have seen through the development of the profession, initially people or reinsurers sought after to very well model catastrophe risks, particularly earthquake. Then they moved on to floods. Then they moved on to other secondary perils involved. However, geopolitical risks has been there in the back burner, and a lot of the economic facilities and organizations and institutions do try to model risk, as it will also affect investment decisions. So in the Arab world, in the Middle East, I don't think there is the capability to price and to model geopolitical risks for reinsurers. However, I know that in London, which is one of their specialties, is that they do provide ability to do simulations on these geopolitical scenarios, not just the Gulf, China, the Gulf, Latin America, and the hotspots in which see or there is a perception that there will be a disruption of some sorts. So yes, it is there, and reinsurers fortunately do the pricing ex ante, that is before the loss, and they do have a loading for large risk, a loading for geopolitical, a loading for natural perils, a loading for the type of hazard and the exposures involved. So it is part and parcel of the overall risk parameter.
How do you expect the reinsurance market to react in the face of possible or potential claims?
I'm reminded by a report released by AM Best very recently that they foresee that there is a limited potential on the regional insurance companies, which I kind of agree. The non-marine side, the retentions are low, and all of these risks, even if they were insured, the war and the political violence, are heavily reinsured outside. So the effect on the MENA region, I would say MENA region-based insurance companies, would not be huge. However, the litmus test would be the renewals, and we have a 1/7 of July renewal coming in. And I do expect reinsurers to go and revisit this issue and try to see whether the rates are adequate. That is on the assumption that there is a prolonged activity of this unfortunate war. If there is a sudden and cessation of this, I don't think this will happen. But as you know, and this is typical in the reinsurance industry, we learn from history, and this would be a very good case right now, like where we had, for example, COVID in the past, and we've had natural floods in the UAE. And this is a good time for insurance companies in the MENA to take a pause and take a stock and try to validate and test the assumptions of their operations. What covers are working? What covers have not worked? Where is the gap of cover? How are we able to restitute all of this? It will be good. And how can we model and capital strain what we have so that similar exposures at least give the comfort that they are being managed? I think there will be a very good lesson out of all of this to do this for insurance companies.
So, still talking about claims, do you think the governments and the GCC will intervene to pay the excluded losses?
Frankly, not. However, of course, this will leave uninsured people in a dire situation. The war exclusion is a universal excuse. It is not something which is a gray area. I draw a parallel to the COVID, in which diseases of this sort was also a common and a natural exclusion. And I didn't see many insurance companies dipping through their pockets, voluntarily paying for COVID-induced losses. I think it's a delicate issue for governments to try to address how they are able to address the situation. However, please bear in mind that the damages have not been large, as far as personal properties are concerned. Of course, there is commercial properties, and there is a disruption of supplies, particularly oil, natural gas, and the like. And many of these commercial facilities, I believe they do have covers of this nature, business interruption. Worst comes to worst, many of these have invoked the force majeure, which relieves them from liability for business interruption for their counterparties involved. I believe the reinsurers will be isolated from this. And even if governments do claim and try to have this with insurance companies, as you know, the reinsurance contract is between us and the insurance companies. We have no direct liability for the policyholders. The relation comes through the insurance companies. What I'm trying to say, while some clients may agree to pay ex gratia, reinsurers would be ill-advised to follow the fortunes because it's a standard exclusion in the coverage.
Yes, of course. And as you said, they won't be doing it voluntarily. During the COVID times. And before that, in Egypt, I remember, during the beginning of the Arab Spring.
But part of it, Osama, has been the debate. Were these strikes and riots, or were this a civil commotion? Okay, and there was a debate at that time behind it. Mind you, really, for reinsurers, it's always the systemic risks. A loss of this nature have a big aggregation potential, not just in a line of business where you will have a huge values, but it cuts through cross lines. The marine, the energy, the credit, the property as well. So you will have this aggregation always as a big fear for reinsurance companies. And as we speak now, I'm sure many reinsurers are carefully trying to do their sums, how much exposure we have in X and in Y countries, and what are the ways to mitigate these risks. Many vessels, there was a report, I am quoting here Aon, that there were 750 vessels of approximate $25 billion of value in the Strait of Hormuz at the end of February. That is 28th of February. So now with 17th of March, probably this figure is large. It tells you the mass amount of exposure it is there. At least on aviations, you can move them to safer places. But marine, that's a big responsibility.
Anything else you would like to add here on the ongoing unfortunate war?
I pray and for the safety of all the people in the region, and mostly pray for the speedy resolution of this conflict, for which the conflict of the war, for which the Gulf has been an innocent bystander. And I hope the wisdom will prevail and we go back to where we were before.
We pray for your safety and all the region as well. Thank you so much. Thanks again for joining us and for sharing your insights. Thank you, Yasser.
Quite welcome anytime, Osam.